Joining us to discuss the Fed's Wednesday interest rate cut and what it could mean for your wallet is Lawrence Sprung, the founder of Mitlin Financial and author of Financial Planning Made Personal. Lawrence, good to see you this morning. We'll get into the detail, but at a high level, what's your overall assessment of this rate cut?
So I think this was highly expected at this point. It's been something that we've heard about, talked about a lot in terms of when that first rate cut would come. And it was pretty clear as of a couple of weeks ago that it was probably coming yesterday. And it's here, and hopefully it'll provide some relief that the consumers and potential home buyers were looking for.
Yeah, and so let's dig into how potentially people might want to respond with their own personal finances. Let's start with their savings. Any advice for emergency funds and other savings, where they should be putting them or changing where they're placed at the moment?
Yeah. So, I mean, if you already had monies in high yield savings accounts or had CDs that are maturing soon, be aware that those rates have and will most likely come down. We got a report from one of the banks that we use for the families we work with that hold FDIC insured deposits for our families. And they immediately, after the Fed decision, cut that rate from 4% to 3.75. So it's already reflected in many bank accounts. So as you have those CDs come due, be aware of that and look at those rates. And if you're somebody who has money sitting on the sideline in banks where you're earning zero, look for a high yield savings account that at least can get you in that 3.75% range, if not higher.
And does this impact retirees who might rely on interest for their savings?
Yeah, so I mean, it's only been the last couple of years where we've had these elevated interest rates. We had a very long period of 20 years plus where people were, virtually getting no return on their assets in the bank. So I think people, although they may be more dependent on it now than they were 2, 3, 4, 5 years ago, it's still something that we don't see a heavy allocation for many people to cash, because the return has still been much lower than they're able to obtain, through more traditional investments.
And what's your advice for paying off debt at this time?
So, I mean, look at interest rates, look at where you're at. I mean, we feel that, when you look at debt, you still need to look at, your budget, how much money's coming in, how much money's coming out. It will make things a little bit easier for those families that do have, for example, credit card debt or home equity lines of credit, because they will see those interest rates go down. So even if they're only able to pay as much as they have been paying, more of that payment should go to principal versus interest. So that will certainly help things out. But in terms of paying it off completely versus letting it go, that has to be a family by family decision based upon what their budget dictates and how they're able to approach that.
And does yesterday's cut impact the housing market at all?
It certainly will. I mean, we're seeing now mortgage rates, 30-year mortgage rates at 3-year lows. So I think you're going to see a little bit of a bump up, perhaps, in activity amongst houses. If you're somebody that has one of those higher rate mortgages, you have to make a decision, because if what the Fed, comes to light and comes true, they're saying to expect another 1 to 2 rate cuts, perhaps even this year. So if you go ahead and start that refinance process, you may be a little early, because if we see another rate cut or 2, you could be doing that at lower rates. So you have to make a decision that, is the rate cut that you're going to see in your mortgage enough to prompt you to refinance, or is that something that you should maybe hold on and see how the next couple of months play out?
And does this advice apply also to things like financing on cars, or does that shift a little?
Yeah, I mean, same thing. You'll see interest rates across the board for borrowing will go down. And, many times people look at that and say, oh, it's going to cost me less. Let me go out and make that purchase. You still have to go through the process of looking at your budget, seeing what you could afford on a monthly basis. And if for some reason that, even at these lower rates does not fit into your budget, hold tight, because there's going to come a time where we're going to see those rates continue to reduce and it may become more attractive. So unless you're in a need situation, make sure that you're evaluating all of your options with regard to borrowing.
Yeah, and you mentioned investors are expecting one or two more rate cuts this year. Any thoughts on looking ahead and planning for that more fully?
Yeah, so I mean, if you're somebody who, is looking to achieve the highest rates always, you're probably not going to want to lock in money. For example, if you're looking at a CD, you're probably not going to want to lock that in for the short term. It would probably be more advisable if you have the time horizon, lock it in for more longer term. Because if you only lock it in for 1 or 3 or 6 months, chances are you're going to have to find a new CD at that time, and it's going to most likely be at a lower interest rate. So if you have the time horizon, lock it in for a longer time, lock in the current rates, because I think it's pretty clear that the Fed has told us that we're probably looking at rates trending downward versus upward.
And for those who may be thinking of starting study or have education loans that they're wanting to pay off faster or get a better deal on, any thoughts there?
So similarly to what we mentioned about the credit cards, you're going to see and should see a dip in the rates there. So the good news is, even if you're making the same payments, if it's not a fixed loan, I should say, if it's a variable rate loan, you should see that interest rate decrease and more of your payment going towards principal. If it's a fixed loan, again, you may want to see if it makes sense to refinance with this lower rate environment that just took place over the last couple of days. But I also think you might be a little bit early, and it really depends on what costs are going to be involved with refinancing. If there are no costs, then refinance now to the lower rate and do it again each time that they lower rates again. So you really have to approach your situation based upon if it's a fixed or variable rate, and then what your belief is about these rates going forward and what the costs are involved with refinancing those loans. It's not a straightforward yes or a straightforward no. It tends to be a little bit more complicated than that, unfortunately.
As you say, it's the financial planning should be made personal, right? How will this recent rate cut affect investment portfolios?
So, I mean, I think it's something that we've been expecting for a long time. We've been hearing rate cuts since probably the end of 2022 or early 23, and it just hasn't happened. The timing hasn't been right. Inflation hasn't cooperated as much as we expected. So I think for most people, and if you haven't been, then you have to start getting to work. But I think most people have been prepared for this lower rate environment that it looks like we're leaning into right now. And if you haven't been prepared for it, you have to start to prepare for it now, because it's going to affect those fixed income investments in your portfolio, and you don't want to be surprised when that starts to happen.
Well, good to hear all your thoughts on this at this particular point in time. That rate cut, long time in the making. Good to speak with you, Lawrence Sprung.
Thank you so much.